why do you want to go broad-based commodity ETFs in a world that's dominated by gold ETFs?
So I think the first thing to say is that we spotted a big opportunity in commodities because of two main reasons. First of all, investors have been paying too much for commodity ETFs, very high management fees relative to equities and bonds. And the products were sort of suboptimal in terms of structure. So you had either partnerships that generated K1s, which can cause investors issues around tax time, or there were notes issued by banks that had credit risk and poor tracking relative to the underlying index. So we thought, here's an opportunity to radically reinvent the space and bring a product that is 40 acts of the same wrapper as what you'd have in equities and bonds, but priced in a competitive level to the rest of the market and lowest cost in the industry.
Yeah, let's talk about the low cost in the industry, because they're low, 25 basis points. The other cheapest I found was like 48 basis points. You have a Goldman Sachs Connect S&P Enhanced Commodity Total Return ETN. That's a whopping 125 basis points. We have a chart we can pull up that kind of shows the differentiation. But you have to make up for a lot in volume then to make up for your loss in fees.
Sure, of course. And due to my experience in the commodities sector and running large commodity funds, I know that market very well and understand how investors think about it. But you've got to understand that there's now a huge amount of money in the market that's driven by machine allocations. And so through the Department of Labor's fiduciary rules coming in, a lot of registered investment advisors are already getting out in front of that and saying, my fiduciary responsibility is to buy the lowest cost ETF. Then you throw on top of the algorithms that a lot of the other wealth advisors use, such as the more fintech-oriented firms who are just going to allocate to lowest cost product, and that's important.